Please be advised that this recorded webinar has been edited from its original format, which may have included a product demo. To set up a live demo or to request more information, please complete the form to the right. Or if you are currently not on CSE Global, there is a link to the website in the description of this video. Thank you.
Hello, everyone, and welcome to today's webinar, Critical Distinctions Between Texas and Delaware LLC Law. My name is Annie Triboletti, and I will be your moderator. Joining us today are guest speakers Byron Egan and Willie Hornberger from Jackson Walker. And with that, let's welcome Byron and Willie.
Well, thank you, and good morning. We're going to be talking about critical distinctions between Delaware and Texas LLC law. Both states have 5 business entities that we'll be talking about today. The corporation, which is the traditional entity, and it is characterized by limited liability of the shareholders. It's not a pass-through entity. The taxation is at the entity level, and then the shareholders are taxed on the distributions made to them. The management is centralized, typically in a board of directors. We have the general partnership, in which the partners are jointly and severally liable for all obligations of the partnership. The entity is a tax pass-through entity, which means that the partnership doesn't pay tax at entity level, and the partners are taxed on the distributions, or I should say on the allocations that are made to them under their governing documents. Then we have the limited partnership, which is a species of general partnership in which you have a general partner that's liable for all of the obligations of the entity, and limited partners who are not liable for any obligations of the entity. It, like a general partnership, is a pass-through entity. There's no taxation at the entity level. Then we have the Limited Liability Partnership, the LLP. And it is a species of general partnership in which, by paying $200 a year per partner to the Secretary of State, you get limited liability, and that limited liability goes to both torts and contracts. Of course, a partner is liable for the partner's own torts, just like a shareholder in a corporation or an officer of a corporation would be liable for the own torts of the individual. Then we have the Limited Liability Company, the LLC, and that is a cross between a partnership and a corporation. It has the pass-through taxation option of a general partnership or limited partnership, and it has the limited liability of a corporation, and it has the feature of centralized management if that's what the parties want. The LLC is a very flexible entity, and probably that's why it's becoming the most popular entity. So we're going to focus on LLCs in Texas and in Delaware, but we're going to discuss other entities for comparison, and because the courts in LLC cases may refer to corporations or other entities for precedent in a particular case. The choice of the state for formation is critical. The state of organization of an entity governs the fiduciary duties of the managers and members to each other and to the entity. So that's a critical factor, and that in turn means that the cases involving fiduciary duties will be tried in the state, or at least governed by the laws of the state of formation, and the case can be tried in a jurisdiction where the entity was formed. So that's important for fiduciary duty litigation, It's also important for bankruptcy because one of the options if you're going to go into bankruptcy is to file in the state of organization. So that's critical. The liabilities of the members and the managers are governed by the laws of the state of formation under the internal affairs doctrine that both Texas and Delaware follow. So if we're talking about courts, it's important to focus on the difference in the courts in Texas and Delaware. In Texas, most of the business disputes will go to the district courts, and those are local courts with elected judges who are elected for a term of 4 years. In the larger counties, the district courts will have subsets for criminal cases and for family law cases, specialized courts for that, but no specialized business courts yet. In smaller cases, you may find the docket includes everything. But in any event, in Texas, you're going to have a judge try a variety of cases. Sometimes it'll be a fender bender whiplash case. Sometimes it'll be a sophisticated corporate case. The appeals from the district court go to the Court of Appeals, where, like the district court judges, they are elected, which means if you have a swing in parties, you may find that the judge that you have has lost an election, is being replaced by another judge who may have less experience generally or certainly with your particular case. Questions of fact are decided by a jury if the parties elect to have a jury trial. Questions of law are decided by the judge, who will then submit by special issues to the jury the questions of fact on which they are to pass. Delaware is somewhat similar, but quite a bit different. In Delaware, they have a superior court that is a general jurisdiction court, like a Texas district court, with, but it does have appointed judges on a bipartisan basis. But most of the business disputes that we're going to be talking about go to the Court of Chancery, which is an equity court, and that's what we'll focus about a little bit. It's the Court of Equity dates back to 1792. They're rather proud of it. They're also very proud of the expertise of their judges. The judges are appointed by the governor by for a 12-year term based on the recommendation of a nominating committee that's in turn supposed to be bipartisan. So the plan in Delaware is for the Chancery Court to be evenly divided. There are basically 4 vice chancellors and 1 chancellor, and so there's an odd number, but at least 2 of the judges will be from one party and 3 from the other. So the Court of Chancery is an equity court without a jury, and that can be very important. The judge will find both fact and law, and that is sometimes good. The fact that the judges serve for 12 years means that they develop a level of expertise that some people think is a plus. But the flip of that is that sometimes the judges have views of the law that are different from what your client might want. So this is one of the things that we would be discussing with our client as we're deciding whether to organize under Texas or Delaware law. An appeal from the Chancery Court would go to the Supreme Court. The Chancery Court will usually write a written opinion explaining the findings of fact and the findings of law. And some of those can be rather lengthy opinions. In one merger case, the Vice Chancellor took over a year to write his opinion that turned out to be 306 pages long. So there was a lot that was in there that you can pick out a lot about what Delaware law is from reading these opinions, but there is, like Joseph's amazing technical coat, there are a lot of strains that you have to focus on, and it can be difficult. Both Delaware and Texas, in fiduciary duty cases, have a strong business judgment rule that says we defer to the informed business judgment of independent directors. But here you see a distinction, because Delaware judges require that the business judgment be informed, and then they will make a decision as to whether the directors were both independent and that they were informed. And there's one case in which it was an M&A case. The board focused on whether the distributions to the limited partners would be increased as a result of the merger. And the court said, no, you didn't exercise business judgment rule because your mandate was determined whether the price was fair, and you focused on distributions, not fair price. So be aware of what you get when you make a request. Okay, in picking a jurisdiction organization. So we're now
Byron,
making, yeah.
I think it's important right now. I want you to comment, because you and I just spent a lot of time on this. I want you to comment on if you're watching costs for a client and you decide to do a Delaware LLC. I want you to comment on the fact that the questions, legal questions involving the LLC. Does the Delaware Chancery Court have exclusive jurisdiction over that, or can the parties vary that by contract, and can they vary it by going to arbitration instead of litigation in the Chancery Court?
And the answer is generally yes. Arbitration is respected in both Texas and Delaware. There are some questions that should go to the Chancery Court, and there's some disputes as to whether, like on winding up and termination, that there is exclusive jurisdiction vested in the Chancery Court. So that's one of the questions that's being litigated right now.
Okay.
So once you think you understand it all, it gets complicated. But even the arbitrator is typically going to pick the law of the state of formation of the entity for determining things. Okay, and that gets you back into what entities are we forming now. And here I have on the screen, in 2019, we formed 2,002 LLCs in Texas versus only 21,747 for-profit corporations, which is about a 9-to-1 ratio. And the limited partnership and the nonprofit corporation were and that's only since 1991. We only had the Texas LLC in 1991. We were the fourth state to adopt an LLC. Delaware followed us by a couple of years. And Texas, they came to me in the legislature and said, we're getting a big fiscal note. We had provided that an LLC would be taxed like a limited partnership as a pass-through entity for franchise tax purposes. And at that point, Texas had a franchise tax that was essentially a 4.5% income tax. And so the limited partnership was a very popular vehicle for that reason. They came to me and said, you can have an LLC, but you're going to get a fiscal note that's going to kill it. So if you want it, then you've got to agree it's going to be subject to the franchise tax. So we agreed that it would be subject to the franchise tax. The result was we didn't form many LLCs at the outset, but in 2006, we adopted a margin tax. So this gets back to the point made earlier that taxation affects choice of entity very much. So since that point, we've been making LLCs much more rapidly in Texas, and the result is we now have 3 times as many LLCs in Texas as we do for-profit corporations. And Delaware, the numbers are somewhat similar, not quite as skewed in favor of the LLC. And in each state, we now have more LLCs than corporations, hence why we're focusing that. Now, in Texas, we have the Texas Business Organizations Code, under which LLCs are formed like all other entities in the state of Texas. This became effective January 1, 2006, and in 2010 it became applicable to all Texas entities. It codified the existing law, but then, of course, every year after that, the Bar Committee that follows the statutes, we read the laws of other states like Delaware and try to keep our statute up to speed with what's happening elsewhere in the country. We also respond to court decisions in Texas and elsewhere. So the TBOC is organized with a hub and spoke approach. So the hub is the Title I. It's the beginning. It has the defined terms in the code. It has the provisions regarding powers of the entity, voting, names of entity, registered office, registered agent, indemnification, mergers, foreign entity qualification, winding up and termination. And then the spokes are the provisions that deal with the particular entities. The LLC is in Chapter 101, and et cetera, and so on. Corporations are in Chapter 2, and so on and so forth. You have to read both the hub and the spoke to understand what law is applicable to your entity. Delaware, like Texas used to be, is formed under the Delaware Limited Liability Company Act. So then we get to taxation, and we talked about how important that is. Willie, you're a tax lawyer. Tell us a story.
Okay. I know this is not a tax course, and I know my place in this program, so I'm going to try to give you just important highlights here from Byron's slides and things that what I'm trying to do in focusing on the short amount of time that I have is important issues for everybody on the call here that we need to be focusing on right now, rather than going through and looking at the basic rate structure and that sort of thing. Okay, so Byron had one slide. I'm not going to spend much time on it. Is what happened prior to 17. We know the rates were 15 to 35% for corporations, and it was graduated, and shareholders were taxed at dividends at 20% plus a 3.8% net investment income tax. Partnerships and LLCs were generally, unless you elected otherwise, were flow-through vehicles, and the owners of the flow-through vehicles were taxed at the owner level. Okay, we had a sea change in 2017 with the corporate rate. If I can get there, here. Let's see. Okay, the corporate rate went to 21%. What's interesting about that, Byron, is that when that rate was enacted, there was a lot of commentary about whether people were going to switch to corporations or to LLCs taxable as corporations because of the lower 21% rate. Interestingly enough, we did not see the flood of people converting to corporations. I think you will find there's two studies, I think, that they're often mentioned. One by, I think, Sam Thompson at the University of Pennsylvania Law School, and another one by Calvin Johnson, tax professor at UT, that analyzed how long it would take with a double taxation of a corporation versus a single taxation of a partnership or LLC, how long it would take in order for the corporate rate to make sense using the use of a corporation to make sense considering the 21% rate. And I think you will find, considering certain assumptions, because if you change the assumptions, you're going to get different answers. But using the assumptions they used in those studies, I think both authors came up with about 23 years, something along those lines, to get the benefit of the flat 21% rate. Okay.
Now, how long, Willie, will that 21% rate last? Isn't there a time limit in the Act?
No, but Byron, I think that what's important for everyone on the call to know here is where I'm spending a lot of my time is considering the tremendous uncertainty right now, okay? And so anything we say right now, we're qualifying with depending on the election, okay? Because depending on how the outcome of the election, a lot of these issues, rates and so forth, could change, okay? So it's important, at least, and especially, like, we do a lot of foreign work at the firm, and what we're trying to do is structure clients right now for maximum flexibility depending on what happens in November. Okay, a couple of things where I'm spending a lot of my time is bonus depreciation. Now bonus depreciation is available for used property. And so in structuring acquisitions, for example, acquisitions of LLC interests, is structuring it to try to maintain availability of bonus depreciation for used property. Let me see, I'm looking here. There is also a lot you've got in your paper here, the immediate deduction, and I just want to insert the word certain depreciable tangible assets, generally 20 year or less, that are available for bonus depreciation, and that's for a limited time, okay, through 100% bonus depreciation deduction through 2022. There's also a lot more. I mean, I'm just scratching the surface here on the interest deduction limitation that was 30%, but for 19 and 20, it's now 50% generally as an added benefit. The only thing I'll say there is a lot of people on the call may think, well, I know, Willie, that there's a small business exemption where if you meet a certain gross receipts test, I think it's 25 million, I'm going to be okay. The only thing to watch out for on those interest deduction limitations is there's certain aggregation rules on the 25 million. And the IRS has got, in preparing for this talk, I noticed on the web, on their IRS website, they've got frequently asked questions on those aggregation rules and when you include other entities in determining whether you meet the 25 million small business exemption. So those frequently asked questions are very helpful, okay? And a lot of the considerations I'm talking about, Byron's got them under corporations, but like bonus depreciation, interest deduction limitation, a lot of those apply equally to pass-throughs, okay? Pass-throughs, as Byron notes here, flow through entities with no entity-level tax, and that's for federal purposes unless you elect otherwise. The rates he's noted there, and for non-corporate investors, got a very good point. Other than certain specified service businesses, it's subject to special rules. A lot of this we're just highlighting. There's an availability of a 20% deduction, okay? So I spend a lot of my time structuring, trying to maintain availability of that 20% deduction, which can reduce, for non-corporate taxpayers, can reduce the overall effective rate for business income.
Now, are law firms other specified service businesses, so they don't get the benefit?
No, they don't get the benefit. But there's certain. What I want to do is be sure that people. I'm giving high level, Byron, because specified service business. I call attention to everyone the special rules that are available and thresholds, because again, we're just scratching the surface. So I'm generalizing, and I want to be sure that people know that under specified service businesses, look at the rules. There is a very good by the Congressional Research Service. It's about 22 pages, and it's available through tax notes, and it's got a very good discussion of the deduction and how it works and illustrative examples. And it's dated June 10th, 2020. The site on it, Byron, is R46402. Let me say that again, R46402. If you're looking for a cheat sheet on the 20% deduction, pull that up. If you can't find it, we'll send it to you or get it posted somehow so you can take a look at that. Byron, I don't want to take up any more time, but just a couple of other points, and then I'll turn it back over to you. A note to everyone on the call, again, what do you need to know right now? Okay, what you need to know right now is there's some COVID legislation rules that suspended the 80% limit on NOLs for 18, 19, and 20. NOLs arising in 18, 19, and 20 can be carried back 5 years. This is a big one. The new limitation on excess business losses for non-corporate taxpayers does not apply for a limited period of time, 18, 19, 20. And a couple of points that I'll make on the franchise tax in Texas, margin tax. This I'll defer to my partner, Steve Moore, that is a lot more well-versed in here, but I'm just going to note to you for the federal tax lawyers some things that are very important to me in structuring using LLCs, okay? We have a margin tax in Texas, okay, and I know a lot of y'all on the call are not from Texas, but I'll just note this to you. We have a margin tax in Texas. Very important, again, first thing I do is call our state tax guy because there's some nuances here. The margin tax doesn't apply to certain passive entities, and LLCs do not qualify for passive entity treatment. So in structuring, I rely on Steve to tell me a lot of what entities I should be using, okay? And if you have a complicated tiered partnership structure, a lot of times if you have an LLC, you're trying to seek passive entity treatment. If you have an LLC anywhere in there, it's going to affect your treatment. Now, I'm not going to spend any time on the operation of the margin tax in Texas because we just don't have time, because Byron's got a lot to cover. All I'm going to tell you is what is very important in Texas, and my understanding from Steve is it's happening across the country, is after the Wayfair decision, okay? Wayfair was a sales tax case that came out of the Supreme Court that dealt with the issue of economic nexus for sales tax purposes, okay? That principle has been extended now to state income tax, okay? Texas, as of the first of this year, has adopted, I'm going to give everybody the rule, new controller rule, okay, new controller rule 3.586 little f franc in the whole, okay? Extremely important to know that Texas has adopted economic nexus. Essentially, I'm just giving you high level, but essentially for a federal income tax lawyer, here's how I understand it. If a business has $500,000 in gross receipts or revenue from Texas sources, even if they have no physical presence in Texas, they're going to have to file a margin tax return. Okay, that's a big deal. And now what we're finding is that other states are adopting economic nexus rules, thus affecting structuring. Okay, on top of all that, Byron, I'm going to turn it back to you. On top of all that, the Texas legislature meets starting in January. The state is in need of revenue. Okay, so we're watching closely what's going to happen during that legislative session. Byron, you can note the Delaware corporate income tax just by way of comparison. Quickly go through that because that's important. The corporate income tax rate is 8.7% in Delaware, but here's the kicker. Specifically exempt is a corporation maintaining a statutory corporate office in the state but not doing business within the state, and corporations whose activities are confined to the maintenance and management of their intangible investments. Income tax does not apply at the entity level to an LLC. Rather, LLC members or partners are generally subject to personal income tax with the highest marginal rate of 6.6%. But here's the kicker again. Non-resident individual members of an LLC are only taxable on their income attributable to sources in Delaware. So if you organize in Delaware and stay out of Delaware, doing business there, and don't have any Delaware sourced income, then you can avoid a material Delaware income tax liability. Byron, sorry, turn it back to you.
Well, I would comment a couple of things. Number one, what you're describing now about the current Delaware approach could change as a result of the things that Willie was just telling you about are going to happen in the Texas legislature. So Delaware is going to be hurting for money too, and it may be reaching out. So what we've got on these slides may not be applicable a year from now. Also, the nexus that is required for income tax purposes, for franchise tax, for margin tax, may be different from what is required to make a decision whether you've got to qualify to do business in Texas as a foreign entity in a limited partnership. The managers of an LLC are generally analogous to the directors of a corporation and are elected by the members in the same manner as corporate directors are elected by the shareholders. However, under the TBOC, an LLC may be structured so that management shall be by the members, as in the case of a closed corporation or general partnership. In that case, the members would be analogous to general partners in a general partnership or limited partnership, and without the personal liability for the LLC's obligations. Under the TBOC, any individual, corporation, partnership, LLC, or other person may become a manager or a member. Thus, you can have a joint venture LLC that has managers who in turn are corporations. So there's a lot of flexibility in how you want to structure your governance. It's also possible to have an LLC with a corporation as the sole manager or the sole member, just like it's possible to have a limited partnership with a sole corporate general partner. The vocabulary in Delaware is essentially the same in Texas. An LLC is formed in Texas when one or more persons files their certificate of formation with the Texas Secretary of State, along with a filing fee. The initial certificate of formation must contain the name of the entity, that it's an LLC, its duration, which is usually perpetual, its purpose, which may be any lawful purpose, the address of its initial registered office, an initial registered agent, and at that address. And if the LLC is to have a manager or managers, a statement to that effect, and the names and addresses of the initial manager or managers, if there's going to be a managed or managed LLC, or if it's not going to have managers, a statement to that effect, and the names and addresses of the initial members, and then the name of address of each organizer, and if the entity is a professional LLC, then whatever information required for a professional LLC, and other provisions that you choose to put in that are not inconsistent with law. The existence begins when the certificate of formation is filed with the Secretary of State, unless it provides for delayed effectiveness as the TBOC authorizes. It may also be, an LLC may also be formed pursuant to a plan of conversion or a plan of merger. in which case the certificate of formation must be filed with the plan. A Texas LLC generally may be formed for the purpose of conducting any lawful purpose, although you may choose to limit the purposes, because if you limit the purposes of an entity and its powers, then you're limiting the business opportunities that are available to the entity, and therefore, for the purposes of business opportunity doctrines, you're limiting the scope of restrictions on managers and members to engage in other businesses. So these are business decisions that you make. The name of the LLC must contain words or an abbreviation to designate the nature of the entity, i.e. that it's a limited liability entity. And in Texas, a majority vote is required to amend the certificate of formation, unless you provide otherwise in the certificate of formation or in the company agreement. So you're going to see that a lot of power, most of the power in the entity is vested in the company agreement, which is adopted by the members. Delaware is essentially formed in the same way by filing with the Delaware Secretary of State. In Texas, most of the provisions relating to the organization and management of the entity are to be contained in the company agreement, which will basically be like a combination of a limited partnership agreement and corporate bylaws. The company agreement in Texas may be written or oral, although there is a statute of frauds, which means if it can't be, provision can't be performed within a year, then it's not enforceable. And there are certain provisions in the TBOC that can be waived or modified by the company agreement. So that company agreement becomes a very critical document. You don't just rely on the statute. The TBOC provides that the certificate of formation may be amended only by unanimous member consent, unless, and here's the biggie, the document provides otherwise. So, such as for amendment by manager consent or majority vote. So, very important provision. Ordinarily contain the capital account, other financial and tax provisions that Willie would find very important in a limited partnership agreement, and he spends a lot of time getting those things to comply with the requirements of the tax code. A company agreement is enforceable by or against the LLC, regardless of whether the LLC has signed or otherwise adopted the company agreement. The code says that you can have a single member of an LLC, and it's not unenforceable because only one person is a party there too. So you've got single member LLCs for limited liability purposes, and it's an enforceable contract by or against that member. Under the TBOC, a member has no right to withdraw and cannot be expelled unless provision is made in the company agreement. Likewise, that's something you want to deal with. The statute provides that a member who exercises a right to withdraw pursuant to a company agreement provision is entitled to receive the fair value of the entity, of the member's interest in the entity within a reasonable time, unless the company agreement otherwise provides. So you're getting to the point that first, there's no right to withdraw or be expelled unless you provide for it in the company agreement. But if you do provide for it, then you provide, in effect, that a member who withdraws can get the fair value of the interest out of the LLC unless the company agreement provides. So this becomes a very important thing to deal with. Delaware is basically the same approach. The limited liability company agreement is what they call the company agreement in Texas, but it's the same thing. And oral agreements are recognized in Delaware as in Texas. but there is the statute of frauds in Delaware too. Single member LLCs are authorized, in fact encouraged. It may be an LLC agreement may be amended as provided therein, or if there's no provision, amendment requires unanimous approval. So very important to deal with the amendment question in your company agreement. Management of an LLC is going to be under the direction of managers who can function as a board of directors and officers, unless you provide that it's to be governed by the members. So this is a choice that you make. If you're a manager-managed entity, you can have a manager who is a corporation or another entity. The company agreement needs to specify who's got the authority to obligate the LLC contractually, or how people can do it. So you also need to provide how managers will be selected, their term of office, and so on. The TBOC provides that any officer or agent who's vested with actual authority is an agent. Any manager, to the extent he's got managerial powers, is an agent. So you need to deal with who is an agent of the LLC in your governing documents. Delaware provisions are comparable to the Texas provisions. Fiduciary duties are a big issue in LLC law as in partnership law. The TBOC, like Delaware law, does not specifically address whether a manager or member fiduciary duty exists, or even attempt to define it, but it expressly recognizes that these may exist in statutory provisions which permit them to be expanded, restricted, or waived, and liability for the breach to be limited or eliminated. So the bottom line, I think you have residual fiduciary duties in Texas, like in a corporation, that are going to be the duty of care, the duty of loyalty, the duty of obedience, unless you provide otherwise in your LLC agreement. Again, the duties of obedience, care, and loyalty. The TBOC has 3 provisions that you need to read together. And if you read them together, they say you can expand, restrict, or waive duties, including fiduciary duties and liabilities of members and so on. There's another provision that says you can limit or eliminate liability to the LLC or its owners or members for breaches of fiduciary duty, and in the case of an LLC manager, except for a breach of the duty of loyalty, an action in bad faith, or a transaction in which an improper benefit was received, or action for which liability is provided by statute, for instance, a breach of securities laws. In my view, if you eliminate, you don't eliminate in Texas, that's Delaware, you waive duties. Then if you waive fiduciary duties, then there should be no fiduciary duty that there could be a liability for, and therefore 701, which has an exception for breaches of the duty of loyalty or action benefit, should not be applicable. Here is a provision that I've cobbled together that attempts to limit fiduciary duties as permitted by the TBOC. And the essence of it is that to the fullest extent by law, you eliminate all duties, including fiduciary duties that may be implied, and then you provide that to the extent, so you've eliminated fiduciary duties, and then you're creating contractual duties as follows. And they're restrictions on competition, have business opportunities to pursue, and so on. These are contractual duties, and they are highly negotiated. Unlike Delaware, Texas does not generally have a common law duty of good faith and fair dealing in all contractual relationships. Rather, the duty arises only when the contract creates or governs a special relationship between the parties. A special relationship has been recognized when there's unequal bargaining power between the parties and certain other elements. And the relationship is not there in an ordinary employee-employment relationship. However, although there are no cases to deal with this point yet, I think that the duty of good faith and fair dealing is going to end up being in the LLC relationships, just like fiduciary duties are likely to exist. Texas, unlike Delaware, does not include provisions that expressly recognize the principles of freedom of contract and the enforceability of LLCs that expand or restrict fiduciary duties, except to the extent I've described above. There is a provision in the code that affiliate transactions are permitted that would otherwise be a breach of the duty of loyalty if the transaction is approved by disinterested managers or disinterested members, or the transaction is fair at the time it's approved. Delaware does not expressly codify manager or member fiduciary duties, but expressly permits the elimination of fiduciary duties in an LLC, although not all Delaware LLCs effectively do so. So more on that point. In 2012, Leo Strine, who at that time was chancellor, was dealing with a merger of an LLC into an entity controlled by the manager. And he held that there was a provision in there that said that affiliate transactions were approved provided that terms were fair. And the court said that what you have done is effectively, by using the fairness standard, incorporate contractually the fiduciary duties. So you may not have had them before, but by putting that kind of provision in, you have created it. And then you said, unless approved by 2/3 vote, it can't be on terms less favorable than could be unaffiliated. It could be entered into with an unaffiliated third party. So the court said that created a general fiduciary duty. The exculpation provision provided that the manager would not be liable if he acted in good faith and without gross negligence. And again, the court said that it created fiduciary duties. The Delaware Supreme Court affirmed that decision and said, although the words entire fairness, fiduciary duties were not there, the choice of words that had been used were sufficient to create fiduciary duties. And the Chancery Court then, on remand, held that, in fact, there were fiduciary duties in this case. The Delaware legislature was sufficiently concerned about that point that it now provides that unless modified in the governing documents, common law fiduciary duties apply to LLCs. So what that means is there's going to be a heavy negotiation between the organizers of an LLC and the investors in the LLC as to what the fiduciary duties of the people that run the LLC are going to be. And the drafter will have a field day doing that. The venture capital groups, the private equity groups have come up with their forms of LLC agreement for Delaware LLCs. that, in effect, acknowledge that there is going to be an elimination of fiduciary duties or a restriction of those duties, but then goes ahead to build in duties that may be contractual or otherwise that would be very much like common law fiduciary duties. So, bottom line, in Delaware, you can write your ticket, but money is going to dictate what the ticket looks like. An LLC agreement eliminating fiduciary duties in Delaware could read as simple as follows: except as provided by law, no manager or member shall have any duties or liabilities, including fiduciary duties, provided that nothing can eliminate the contractual duty of good faith and fair dealing. Now, as I said earlier, that provision is subject to intense negotiation, and you may end up with a provision that looks a lot like a Texas provision that I had up earlier that does deal with the kinds of duties that are owed. So then you also have to deal with the Delaware courts, and while they have expertise, they also have very strong views. So they feel like if you're going to eliminate fiduciary duties or restrict them, you've got to be explicit and conspicuous. And they have said coyness can lead to unenforceability. That's words of Vice Chancellor, then Chief Justice Strine. So a language in the LLC to the effect that no member or manager shall be liable for any act attributable to gross negligence, fraud, or willful misconduct provides exculpation for monetary liabilities, but having used a bad faith limit on exculpation has been held to assume rather than eliminate common law fiduciary duties. So you may eliminate a liability, but then if you've eliminated a liability, wait a minute, is there a remedy? Well, you've got an equitable remedy, and it may be rescission, where you get your money back. So the courts have a field day in doing the justice that they want to do. Delaware is very clear that persons who control members can be held for fiduciary duty breaches of the members. Also, a legal claim exists in Delaware for aiding and abetting a fiduciary duty, whether arising under statute, contract, or otherwise. So you think Delaware is going to eliminate liability, then you find that the courts are not going to let that happen. So there are several recent cases that sort of deal with limited partnership reorganizations that will provide some color on this. In each case, you're going to have an affiliate transaction. The general partner is trying to squeeze out the minority interests. And in 4 of those cases, the Delaware Supreme Court gave effect to the elimination of common law fiduciary duties and their replacement with a provision that authorized related party transactions where a conflicts committee of independent directors of the general partner in good faith determined that the transactions were in the best interest. But you notice the requirements: independence, good faith. So what happens? Well, you got the duty of good faith and fair dealing, which cannot be eliminated. In one case, there was a merger, and they got a fairness opinion from a very reputable investment banker that the transaction was fair from a financial point of view to the entity. The court said, no, that's a breach of the good faith and fair dealing, because that fairness opinion should have said it's fair to the limited partners who are the people that are really being affected by the transaction. Hence, you see a provision being construed to reach a result that the court thinks is equitable, a court of equity in action. Another case, Statement versus Regency, a reorganization. And there you had a fund that had appointed directors to serve on a special committee, but the director was formed really just for the purposes of serving on this committee, and then immediately afterwards, the director went back to work for another affiliate of the general partner. So you've basically got somebody that was an affiliate, not independent, before the special committee was formed, resigned from his positions, then served on the special committee for a couple of weeks, approved a transaction, and then went back into the payroll of the general partner. The Supreme Court held, no, that's a breach of the duty of good faith and fair dealing. I said to the Chief Justice, hey, that's a duty of loyalty case. And you've waived the duty of loyalty. You've eliminated it. And they said, no, this is such a fundamental disclosure failure as to negate the approval by the unaffiliated limited partners, and therefore that's a breach of the duty of good faith and fair dealing and a breach of the contract. So again, you see an example of how a Delaware court can reach a result to apply justice, notwithstanding the elimination of fiduciary duties. Then you've got another case in which $171 million was awarded to the plaintiff limited partners because the court found that the conflicts committee of the general partner did not in fact believe that the transaction was in the best interest of the partnership. The conflicts committee focused on whether this transaction would increase the distributions to the limited partners rather than whether the value that was being received was fair. And the court said that you made the wrong finding. You focused on the wrong thing. And so because you focused on the wrong thing, you didn't in fact exercise business judgment. And it was not independent. And so basically $171 million was awarded. The finding of the committee was that the deal was a good deal because it would increase distributions. Increasing distributions increases price of the units and increases value, but for the limits. But the court said no. The real test is the value fair, and that's not what you found. Now, that case ultimately died in the Supreme Court because by the time it got up there, the merger that was at issue was consummated, and the court said that you've got to be a member at the time of the transaction and at the time of the judgment. And because you weren't a member at the time of judgment, you've lost your standing. That's a derivative rule that's also applicable in Texas. Delaware corporate fiduciary duty law embraces the duties of care, including judicial deference to the informed business judgment of disinterested director. We talked about that. And we've got a strong business judgment rule. Like Delaware, like Texas, Delaware holds that directors who found violated their duty of loyalty when they failed to act in the unlike Texas, Delaware holds that directors may be found to have violated their fiduciary duty laws when they fail to act in the face of a known duty to act, i.e., they act in bad faith. And that was first articulated in the Caremark decision in 1996. And that was, in essence, an accounting case, and they didn't have a sufficient set of internal controls that the directors could make informed decisions, and the court held that that was a breach of the duty of loyalty. Fast forward to 2019, you have the Bluebell case. That's Marchand versus Barnhill. That's the Delaware Supreme Court. And that involved the Texas Bluebell creameries that make Bluebell ice cream that we all love in Brenham, Texas. So we're talking about a small town corporation that makes ice cream. But that ice cream got tainted with Listeria bacteria. 8 people were sick and 3 died. So Bluebell had to engage in a big recall, suspend operations, lay off a lot of its workforce, and entered into a highly dilutive transaction with a private equity investor. The board was sued, in a derivative action alleging that the directors breached their duty of loyalty. The Supreme Court held that while Bluebell had food safety programs in place and nominally complied with FDA regulations, the complaint alleges that Bluebell's board had no committee overseeing food safety, no board-level process to address food safety issues, no process by which the board was expected to be involved with food safety reports and developments. So it created an inference in their pleadings that they failed to assure a reasonable information reporting system existed. To satisfy their duty of loyalty, directors, the Supreme Court said, must make a good faith effort to put in place a reasonable system of monitoring and reporting that is central to the corporation's main compliance risk. Without more, the existence of management level programs is not enough. So in that case, management did have listeria controls, but it was a small company and the board was not involved in the process. Management did it. The Imperial CEO, and the court held that was not enough. The Chancery Court thought it was, but the Supreme Court said it wasn't. So if that case was being tried in a Texas court, we would come to a different conclusion. Texas has a very strong business judgment rule, and a duty of oversight claim would be treated as a duty of care case, and the business judgment rule would apply, and directors would not be liable. But in Delaware, the result is different, and there were 3 other cases in 2019, and there have been a couple so far in 2020. So Caremark is a vibrant issue. Okay, we've gone through the code. Business combinations. Willie and I do a lot of stuff involving LLC mergers. And the statutes in Texas and in Delaware allow a merger of an LLC with another entity. And you have it approved by the managers and then by the members. There are no appraisal rights in either Texas or Delaware unless you provide otherwise. It must be approved by a majority of the members unless a certificate of formation or company agreement provides otherwise. You can also convert to another form of entity or convert into an LLC from a corporation or anything else. So as we said early on, you can convert a corporation into an LLC. You can convert a corporation into any other form of entity if the statute dealing with that other form of entity so permits. Under the TBOC, we have the concept of divisive merger. And this is one where Delaware has just copied Texas. We have in the hub provisions a provision to the effect that an LLC can merge into itself, creating 2 or more surviving entities, and can divide in the plan of merger the assets and liabilities among the parties as they choose in the contract, without prejudice to the rights of existing creditors, and of course subject to fraudulent transfer and other laws. So the way they get there is merger in the TBOC includes the division of an LLC into 2 or more domestic entities or other organizations, or into a surviving domestic entity or 1 or more non-code organizations. So you could have a corporation that wants to divide up, and it could adopt a plan of divisive merger where it will form a new LLC as a subsidiary, and it will, in the plan of merger, allocate the assets and liabilities between the 2 entities as the parties choose. It's the express allocation and investing of assets and liabilities is absolutely critical contractually. Delaware, and by the way, we say in Texas that when a merger takes effect, there is not an assignment for the purposes of underlying contract provisions. That's very important. So if a contract says it's not assignable, you can do a merger, and that would be not an assignment under Texas law. I think Delaware would come out to essentially the same place. Delaware will also allow mergers like Texas. Delaware has a concept of a division, whereas Texas will allow a divisive merger involving corporations, limited partnerships, LLCs. Delaware initially would allow only, and that was only in 2018, a division of an LLC into more than one entity. And it's essentially the same as in Texas. They have recently amended their statutes to where the limited partnership may also affect a divisive merger. They call it a division, but it's the same thing. Indemnification. In Texas, you can indemnify the managers and members to the extent you want to in your company agreement. I always advise people use long form provisions, because if you use a short form, you don't know what you're going to get, and there's always a risk that if you put in to the maximum extent permitted by law, a court may say that's void for vagueness. We can't tell what the restrictions are. Delaware has essentially the same provisions. Capital contributions are dealt with in the company agreement. Allocations of profits and losses, which is very important for William tax purposes, same way. Legislative history of the TBOC says that there is no liability for piercing the entity veil. Court cases didn't respect that, and the result is we amended the TBOC to effectively say that except if there's actual fraud, there would not be a veil piercing. Membership interest can be divided up into various classes. And winding up and termination is provided upon the occurrence of these provisions where the perpetual, well, you can provide in your company agreement that duration is perpetual, but the statute provides for winding up and termination as you want to do it in your company agreement. And there's always judicial dissolution, provisions for foreign organizations. LLCs can be divided up into series, and diversity jurisdiction. You look at the citizenship of the members, and like a partnership, it's deemed a citizen of each state in which it has a member.